Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Ian, welcome along today.
Thanks, Don. Good to see you.
You too as well. Making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Luckily, Ian today with his latest press release. Ian, last week you mentioned the real war is upon us. Now Europe and China join in. Tell us more about the global currency war that's going on.
Well, if we went back only a week ago, Don, we were surprised that the US Treasury had sold euros to buy Japanese yen. And there was a certain amount of conjecture in the financial press that wasn't the thing to do, and it had never been done before. Turns out that Europe have already started a facility for non-EU central banks so that they can borrow euros in stressed times when liquidity is needed. So that was set up 24th of July. Sorry, they confirmed on 24th of July it's going to happen. They've onboarded some central banks, non-EU central banks already, and it's effective on Q4 2026. So this was a facility that's already there to European central banks after COVID. And now they're willing to lend euros to any, I suppose, approved central bank throughout the world, which is kind of only the remit of the US Treasury, because that's the global reserve currency as dictated in 1944 at the Bretton Woods Accord. And who could blame Europe after you've got Trump in power, right? But simultaneously, and for 21 months, China's been buying a heck of a lot of gold every month because they want to settle trade in gold. They're not expecting to exchange it, but it will be a payment or escrow mechanism that is secured by gold. So it has some intrinsic value. And they bought 20 metric tons in July, and that was announced last week on 7th of August. So that was, I think, Thursday. So 20 metric tons is a huge amount. Not to say that Chinese citizens can buy too many things apart from gold and Chinese real estate. And given the parlous state of Chinese real estate, you would buy gold. But nevertheless, the accelerating pace of gold purchases and its traditional role as securing currencies, it's a fairly obvious situation that there and the euro are preparing for the demise of the US dollar, I would say.
So you think that continued gold buying by China, they're preparing for a weaker US dollar reserve system effectively?
Yeah, I think so. So supposedly, and it's difficult to find the details, 90% of oil that comes out of the Hormuz Strait, assuming any does, is settled in yuan. So clearly the petrodollar, which sustained the world after the US was kicked us out of, or rather Nixon had to take it off the gold standard because it was bankrupt. So the dollar was suddenly, due to Henry Kissinger, secured by energy oil. I think we mentioned this last week. But that has changed. And in fact, in 1975, I think it was, Henry Kissinger arranged for Saudi Arabia only to sell oil in dollars in exchange for the US protecting them with weapons, screening, all that sort of stuff. So that has changed and is not the case anymore. And everybody is worried that the US financial situation and preparing for any other eventuality, I suppose.
So what does that mean for US Treasuries and US dollar and global reserve asset allocations?
Well, for US Treasuries, it's a big problem because the US Treasury bond is supposedly the risk-free asset that the US has been telling everyone has to secure the money market system, and it is absolutely entrenched in everything. So most collateralized lending, which is a significant amount of the market, probably the majority of it, is secured with US Treasury bonds. So Mr. Besant is trying to push lots of dollar stable coins out there in America, but they have to be backed by Treasury bonds.
Mm. Mm.
Problem is, what happens when your Treasury bonds go to nothing?
Yep.
Everything explodes by definition. The whole world becomes immediately illiquid. And so it is, in fact, you're right if you were suggesting that it's Treasury bonds rather than the dollar that is the big problem, because it is. Absolutely. And we saw this week that Japan has been pushing domestic buyers of JGBs, Japanese government bonds, to buy more. And they basically said no, because they've taken such a massive haircut from rates at 0 to rates at 4%. It's like a 60% haircut on what is meant to be the safe domestic bonds. Would you like some more? I don't think so. And we're seeing this with US Treasuries now. Okay, there's 40 trillion out there, it needs a significant increase in yield to lure investors in to have some more of it, right?
If the central banks, the European central banks, can borrow against high quality collateral with fewer restrictions, does this reduce crisis risk or encourage more leverage?
Well, it's only non-European and European central banks that are borrowing it. So it's like the FX swaps that the US Treasury via the Fed put out. If there's a financial crisis, countries via their central bank can borrow dollars and do something with it, lend it to the banking system normally, right? So that everyone has liquidity.
And the other thing, are gold and foreign exchange reserves becoming more strategic weapons in a broader currency war?
Gold has risen significantly in terms of the value in global central bank reserves. Now, some of that is, of course, the price increasing quite a lot. But China has set up centres in Hong Kong and others where you can buy and sell super big bars that are for settlement by central banks, i.e. big money moving around, like in the vaults of the Bank of England, where effectively I sell you, £1 million bar of gold, and they just change the post-it notes on it. The gold never leaves. It's a reserve, and who owns it is just a matter of record. Currently, that has all been happening in England, in London and the Bank of England for the last 400 years, and then to some extent some trading on the COMEX in the US. So gold and probably silver is moving into global financial reserves very quickly now. Does it mean anything in terms of gold? Not necessarily. It's your non-sovereign choice when you don't trust any fiat currencies to start with, right?
Anything else that you wanted to share before we went through this week's charts?
No, only that talking about gold,
Yep.
that really has been the focal point of markets because it has been so incredibly volatile for once. So gold hated when Mr. Warsh, his first Fed meeting, and he appeared to be very hawkish. So that meant that rates stayed higher for longer, and that real interest rates, i.e., let's say your 10-year yield minus inflation, is higher. Gold not bearing any interest, obviously you might switch to something with a high yield. But now that we have Mr. Besant and the Bank of Japan doing this currency stuff, we're assuming that every country is going to have to print money and debase their debt away. Because if you're selling dollars, yen, euros, you're printing them because you haven't got them, because every country is running massive deficits. Western countries is running massive deficits and, pretty much insolvent if they were a company or an individual. So they're going to have to print it to be able to keep selling or buying it. What does that mean? It means that all fiat currencies are being debased and gold goes to the moon. So we're seeing the charts that gold spiked up on that stuff with Besant selling euros for yen, and the Bank of Japan, of course, buying yen against dollars.
Sounds good. Let's look at those charts then.
All right, starting with Bitcoin as usual. I've been doing some stuff with, this is the all-time high at 125,000, let's say. And so we've had a 36% correction, followed by a rally, followed by 38% correction, followed by 30% correction. And we've kind of broken through this resistance downtrend, but really it's been pretty feeble. Liquidity is low, although China is stimulating its economy by printing more money. So that might be something to suggest that Bitcoin is nearly at a low, can't go down forever. Ethereum, which really almost hit the point of no return down here, but managed to rally and is now hanging about a bit. So not really much to report there. So gold with a hawkish Fed comes crashing down. Suddenly we have some currency wars and it's gone up. So it's gone up 10% in a week, which for gold is humongous. It's got a lot of work to do to get up to where it was before, but it's hanging in there. Silver as well, which has kind of not been doing anything for quite a bit, has suddenly perked up. Still only 50% of its all-time high, which was in January. So precious metals suddenly perking up on debasement fears or hopes, depending on your perspective. Brent crude has come off a lot as the war with Iran has appeared to die into the distance, if not ended. And then we had a spike and now it's come off again. So it's kind to pull back to its real value. And given that most countries now need to top up their oil reserves, I expect it to be not going down too much from here. But the world has stopped looking at it specifically. 2 weeks ago is all we were looking at. So the dollar, what is the dollar doing? Well, the dollar has a kind of downtrend in an uptrend. So this parallel here is a 15-year uptrend. The Fed cutting here didn't help the dollar go lower. It went higher. But we've had a really big bounce and we've met a lot of resistance here and it's come down. So what does that mean? Well, nothing actually. It doesn't mean anything. But if you look at dollar yen, you'll get a better signal, I think, because here we have what we've discussed so many times is central bank intervention, bigger central bank intervention. From 164 this time, we're back at 158. So you could say it's lost 4% of its value, dollar yen. Is that a big deal? Well, it's still going in the wrong direction for those central banks. The euro, so suddenly everyone's interested in the euro, which was in a bit of a downtrend against the dollar, has suddenly perked up. So we've broken out of our downtrend channel and spiked up, and now we're digesting the move, but looking strong. Aussie's looking quite strong, and we've been looking at this line that's been hanging around for ages, and it seems to have broken free of it, which suggests a lower dollar is coming. If we look at the Chinese currency, this is the offshore yuan, you'll see a clear picture here that since, a year, April 25, it's done nothing but appreciate against the dollar. And given that this is meant to be pegged, and the People's Bank of China is meant to be managing that peg, I think you'll see what's really happening to the dollar in this chart. 10-year yields have gone up. So we were in a wedge formation here, which broke, retraced back into it, broke, went up again. So we seem to have broken clear and are hovering around 465, sorry, 470. The US Treasury is buying its own bonds crazily, and for the reason that it cannot afford rates to get any higher, or the 1.2 trillion a year bill on interest alone will go through the roof. Financial repression is here already, in that they are manipulating the markets, as they're now having to do with currencies. What happens when markets are manipulated? The authorities get away with it until it doesn't. When it doesn't, everything goes horribly wrong. So the 30-year bond is up at its highest since COVID, and Japanese yields are still rising. So that's better with the 10-year. So it's a clear uptrend that we're in. And so the currency has to weaken and yields go higher until someone goes and buys those Japanese government bonds, or no one turns up to buy those Japanese government bonds. Hence the problem we're having. Stock markets, despite all of the experts telling us it's going to crash continuously for the last 5 years, hit an all-time high on Friday. That's the S&P. So we had this weird X there, but it signaled quite nicely the indecision, and now we've broken higher. Why have we broken higher? Because of the thought that central banks are going to be printing money again. Always good for risk assets, Bitcoin, tech shares, gold probably these days, but money that can be moved rapidly into assets. The Nasdaq is kind of nearly there again. Not quite yet though. The Dow Jones is at its all-time high. So despite some of these tech stocks getting really hammered, so this is Oracle down, 60%. IBM absolutely slaughtered. SpaceX, which has actually come back quite a bit. Despite those draws down, the capital has rotated into Microsoft, Apple, all of these safer names. So those names are now the safe haven that gold used to be, for example, now that gold's moving around a lot. That's the charts for the week. All watching gold and the dollar, and 10-year bonds. We've got the RBA this week. Yep. Any views on that, Don?
I would like to think no change. What's your view?
Yep. Who knows what they'll do? Got a feeling that they should be hiking. We've also got US CPI on Wednesday, which is the most important thing this week. PPI on Thursday as well, because all of that stuff about the Fed and what are they doing, and how concerned are they of being above inflation target and all that sort of stuff, that comes into play. And after the non-farm payroll on Friday was negative, so the US produced negative jobs on Friday.
That meaning they put more on than they put on.
Yeah. Obviously, there's lots of things in there. Government jobs went down a lot, for example, but they also revised down all the previous months. So the solid job growth that Trump has been crowing about turns out, by his own statistics, not to be true. So what happens to change all of this bull market in equities, the thought that America is doing really well and GDP is high, which it isn't? And what happens to the RBA when, okay, inflation is higher than they want, but when the job market tanks, that's recession for sure, right?
Yeah.
And
yep.
Can you have a recession and high inflation? Oh, yes, you can, which is the worst, which is stagflation, which is the worst outcome. But, if we're going to have lots of jobs lost, then that's everyone's excuse to cut rates.
Absolutely is. Yep. Well, very interesting. Anything more for this week?
No, I think that's it, actually.
Okay. All very interesting. And the financial war goes on. Look forward to seeing what happens in the next week then.
Yeah, so Bank of Japan will have to intervene if it gets dollar yen gets up to 164 again.
Yep.
Possibly won't happen this week, but all I know from 30 years is when you try and manipulate the markets really challenge you. So I'm
Yep.
expecting another punch up.
All right. We wait till next week then. So that's another wrap up of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website. Alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Thanks again, Ian, for this week, and thanks for all those listening online. Thank you.